Something in the silver market has shifted, and the shift is not subtle. It did not arrive with a headline or a public announcement. It showed up in behavior, in how prices responded, in how institutions stopped reacting the way they always have. For years, every aggressive move higher in silver was met with the same response. Paper volume increased. Selling pressure appeared. The move was capped. This time, that response didn't come. The resistance that defined this market for decades simply wasn't there. And when institutions stop fighting a price they've controlled for years, it's never because they suddenly agree with it. It's because the cost of fighting it has become higher than the cost of letting it move. Silver is not behaving like a market that is calm or balanced. It is behaving like a market under strain. A market where the surface price no longer reflects what is happening underneath. What looks like stability is actually tension being held in place by habit, not by supply. And habits break quickly when inventories thin, when delivery pressure rises, and when the people responsible for managing risk quietly step back. The question circulating right now is not whether silver can move higher in theory. That debate has existed for years. The question is why the mechanisms that once prevented those moves are suddenly absent, why the same players who once leaned aggressively against price strength are now allowing it to stand. That change matters more than any headline number because it signals a shift in control. For a long time, silver was managed primarily through paper, futures contracts, options, synthetic supply, large volumes traded without metal ever changing hands. That system works as long as confidence holds, as long as participants believe that physical silver will be there if and when it is demanded. But confidence is not infinite. It erodes when delivery requests rise faster than inventories. It weakens when premiums detach from spot prices. It breaks when paper claims multiply while physical stockpiles shrink. Those pressures have been building quietly. Warehouse reports have shown gradual drawdowns. Not dramatic enough to alarm the casual observer, but persistent enough to matter. Ounces leaving storage and not being replaced at the same pace. Registered inventories tightening relative to open interest. Ratios moving in ways that only appear when the margin for error is gone. At the same time, physical premiums have been sending a message the paper market cannot hide. Coins, bars, and industrial forms of silver have been trading well above the quoted spot price in many regions, not because of temporary demand spikes, but because supply is not meeting real-world needs. When the price on a screen says one thing, and the price required to obtain metal says another, the screen eventually loses authority. This divergence has been especially visible outside the West. In Asia, silver has consistently commanded higher prices, in some cases double-digit dollar differences per ounce compared to Western benchmarks. That gap is not an anomaly. It is a signal. It reflects where physical metal is flowing and where it is being retained. China, in particular, has emerged as a quiet but relentless force in this market, not through dramatic announcements, but through steady accumulation tied to industrial demand, energy infrastructure, and manufacturing supply chains. Silver is not just a monetary metal. It is an industrial input that cannot be easily substituted. It is essential to electronics, solar panels, electric vehicles, and advanced manufacturing. Demand from these sectors does not respond to price signals the way investment demand does. Factories do not pause production because silver is more expensive. They secure supply first and adjust costs later. That dynamic changes the entire risk profile of the market. As industrial demand absorbs more physical silver, less remains available to satisfy financial claims. This is where stress begins to show. Futures markets were designed to facilitate price discovery and hedging, not to warehouse physical scarcity. When too many claims chase too few ounces, the system relies on rollover, cash settlement, and confidence. Banks and large institutions manage this balance carefully. When they sense that physical delivery could become a problem, behavior changes. One of the clearest signs of that change is the absence of aggressive price suppression during recent rallies. Historically sharp upward moves were met with heavy selling at key levels. This pattern trained the market to expect reversals. It discouraged momentum. It reinforced the idea that silver had a ceiling. That ceiling now looks less defined. Price advances are being met with hesitation rather than force. Volume patterns suggest accommodation, not confrontation. This does not mean institutions want higher silver prices. It means the tools they once used to contain those prices are becoming less effective or more costly. Margin requirements have increased. Delivery risk has grown. The cost of sourcing physical metal to back paper positions has risen. At some point, the rational response shifts from defense to damage control. The futures market itself reflects this tension. Open interest remains high relative to available deliverable supply. Delivery notices have increased during periods when they would normally remain muted. These are not random fluctuations. They are symptoms of a market adjusting to constraints it cannot easily remove. Each delivery request forces a choice: locate metal, persuade a counterparty to roll, or settle in cash. None of those options are free. Meanwhile, central banks and large financial entities are operating in an environment defined by liquidity injections, balance sheet expansion, and currency dilution. While silver is a small market compared to sovereign debt or equities, it is sensitive to these forces. When trust in paper instruments weakens, tangible assets gain attention. Silver sits at the intersection of industrial necessity and monetary skepticism. That combination is volatile. The idea of $100 silver circulates not because it is a neat round number, but because it represents a repricing that acknowledges years of imbalance. Whether that exact figure is reached is less important than the path toward it. Prices do not move smoothly when systems adjust. They gap, they overshoot, they pause, and then move again. What matters is whether the structural forces pushing upward remain in place. Banks appear to be acting as if those forces are real. Risk management strategies have shifted. Exposure is being reduced or restructured rather than expanded. In some cases, long positions have quietly replaced short ones. This is not publicized. It shows up indirectly through changes in positioning data and through the absence of familiar resistance patterns. When the largest players stop pressing their advantage, it suggests the advantage no longer exists. Inventory stress reinforces this view. Silver is consumed, not just stored. Unlike gold, much of it is used in ways that make recovery uneconomical. Once embedded in electronics or infrastructure, it is effectively removed from the market. Recycling exists, but it does not respond quickly enough to offset demand surges. This creates a structural drawdown that paper markets cannot replenish. Supply growth, meanwhile, has been constrained. New mining projects face long lead times, regulatory hurdles, and rising costs. Many silver mines are byproducts of other metal operations, limiting the ability to ramp production in response to price alone. This means supply is relatively inelastic in the near term. When demand rises, the adjustment happens through price, not volume. These conditions create an environment where traditional price management becomes fragile. Each attempt to suppress price increases pressure elsewhere in the system. Premiums rise, delivery requests increase, inventory ratios worsen. At some point, the effort becomes counterproductive. Allowing price to rise can relieve pressure by reducing demand and attracting supply, but it also reveals the scale of the imbalance. China's role amplifies this dynamic. By securing physical supply through long-term contracts and strategic purchasing, it removes metal from global circulation. This does not require dramatic announcements. It operates through routine trade flows that accumulate over time. The effect is cumulative. Western markets see less available metal, while Asian markets maintain access at higher prices. Arbitrage becomes difficult when export restrictions, logistics, and policy differences intervene. The result is a fragmented market. Paper prices reflect one reality. Physical prices reflect another. Institutions operate between these worlds, managing risk as best they can. When the gap between them widens, something must give. Historically, it is the paper price that adjusts, not the physical one. This adjustment does not happen in a single moment. It unfolds through a series of signals that are easy to dismiss individually, but impossible to ignore collectively. Rising premiums here, inventory drawdowns there, a rally that is not immediately sold, a delivery cycle that strains logistics. Together, they form a pattern that suggests the old playbook is no longer sufficient. The idea that banks have stopped fighting the price does not imply surrender in a dramatic sense. It implies recalibration, a recognition that maintaining the previous range carries unacceptable risk. In financial systems, control is rarely abandoned outright. It is relaxed gradually, often until the new equilibrium is discovered. That process can be disorderly. Throughout this period, language matters. Institutions rarely admit stress directly. They speak in terms of efficiency, optimization, and market function. But behavior tells a clearer story. When price action changes character, when volatility clusters, when resistance fades, those are the real messages. The current environment is one where silver is being reassessed, not celebrated. There is no euphoria, there is caution, there is tension. These are not the hallmarks of a speculative top. They are the conditions under which repricing occurs reluctantly, pushed by necessity rather than enthusiasm. It is also important to understand what this moment is not. It is not a resolution. It is not a final outcome. It is a phase, a window where the balance between paper promises and physical reality is being tested. That test does not end quietly. It ends when one side asserts itself. If physical availability continues to tighten, if industrial demand remains firm, if foreign accumulation persists, then the mechanisms that once kept silver contained will face increasing strain. Allowing price to rise becomes a release valve rather than a threat. That shift in perspective changes everything. The calm tone surrounding these developments is deceptive. Markets often look most orderly just before structural changes become visible. The absence of panic does not indicate safety. It indicates that adjustments are being made behind the scenes. By the time those adjustments are acknowledged publicly, the easy phase is over. Silver has always been a market where small imbalances produce large moves. Its size magnifies stress. Its dual role complicates management. In this environment, the signals point in one direction, even if the path remains uneven. The coming period is defined by uncertainty, not clarity, by transitions, not conclusions. The forces at work are slow-moving but powerful. They do not require constant headlines to operate. They accumulate pressure quietly. Whether silver ultimately trades at $100 or some other figure is less important than the fact that the constraints shaping its price have changed. The fight that once defined this market has softened, not because it was won, but because continuing it carries greater risk than adaptation. That is the situation now. Unstable, unresolved, balanced on a narrowing margin between paper confidence and physical reality. In markets like this, silence often speaks louder than action, and the silence from those who once dominated price action is telling. What happens next will not announce itself in advance. It will emerge through behavior, through gaps, through adjustments that only make sense in hindsight. This window will not remain open indefinitely. The forces in motion do not pause. They continue, quietly, until the balance breaks or resets. For now, the system holds. Barely. And that fragility is the most important signal of all.